and let's get started. So we're going to start with the foundation for wealth creation, okay? And that is multiple streams of income. Everybody's kind of heard this, and so the whole idea is, come on in. Grab a seat, there's one in the back, grab a sandwich and grab a seat, and a seat right here, and a seat back there, and a seat right there. Okay, so income can be, from a job, can be from, side jobs. A lot of times we're living in this sort of gig economy where people are, you heard about the teachers and they're all, getting side jobs and all that kind of stuff. So one of the things I'm going to be talking about today is what we see as potentially the greatest shift in what we call economic democratization of the capital markets. And, spoiler alert, it has to deal with the Jobs Act, right? And so income is basically all the ways that you earn money on the W-2 type of a thing or different things. So people then will go and they'll start investing in real estate because they can create some kind of a residual income from rents or flips or something like that. You start investing in annuity and stocks, and those are the things that most people will first think of. And part of the reason why, if you think back, let's go back, this is why the Jobs Act becomes important, and we're on sort of this threshold. If you go back 30 years, who invested in real estate? Only the most wealthy and institutional funds, right? It was the Robert Kiyosaki's of the world, which I'm going to be coming back to, cash flow quadrant guy. And all the people that you know of that have created great wealth from real estate, they were entrepreneurs that did real estate, right? They developed, okay? But now real estate as an investment attitude is really more about the buying and selling and flipping and creating rental income. And so, but what changed was the capital markets and how people were able to write off their taxes on that, and how they were able to get access to capital without having to have all the money themselves when it became an investment property. And then knowledge, right? People started teaching people how to invest in real estate. And it became a whole cottage industry in and of itself. And say, you can always go get training on investing in stocks, right? And there's also specialist wealth managers out there that will help you figure out how to invest in stocks. But the ones that do the best at it, a lot of times, as Robert Kiyosaki would say, they grow their financial IQ, right? And one of the reasons why you're here today is they're growing your financial IQ. And so one that hardly anybody ever really talks about, because up until 2012, it was really, again, only the most wealthy and the institutional funds that ever did private equity. And so I'm going to talk about that, and I'm setting the stage. So one of the things my heritage is IBM from the corporate world, and they used to teach me when we were first learning how to tell them what you're going to tell them, and then tell them what you told them. So that's my model. All right? So generational wealth. All these people, you recognize these names, right? What do they all have in common? They all created a company that grew way beyond them. Ultimately, most often went public, and even beyond the family, like the Ford, right? There's still a name company. There's still people within that family that have created that have benefited from the wealth that was created from these different entrepreneurs. Jason Kokonis, who y'all probably know if you follow much in the angel investor space, he's the one that came out with the angel book almost exactly the same time I am. He's a little bit more famous than me. But he is the one, he invested in Uber. He made his stuff in tech companies to begin with. He's kind of like the guy that, he's got Tech Talks, I think is his podcast. About 2 years ago, I recently listened to it because I've been going back in and listening to things about crowdfunding and stuff like that. And he was interviewing the founder of Seed Invest. And one of the things that he said in that, which really resonated with me, and one of the reasons why I read the book, was he says, he started his first company when he was 25. And he said, if I knew then what I know now, I might have still started my company, but I would have taken, come on in.
Sorry, I'm late.
No problem. Grab a sandwich and a chair. Sure. You got choices up here. You can slide in the back. He said, if I knew then what I knew now, I would have taken I would have, figured out a way to carve out stuff like maybe not have as much of a big data plan. I'd give up $2-3 a day coffee addiction. I would take one of my paychecks a month, something where I could put some money every month into a Reg CF crowdfunding company. And even if it was just $100 or $1,000, whatever it is, I would start doing that now and do it on a regular basis, because one of those companies would hit and would be as big as what I was able to do with Uber with $100 grand. okay?
You never actually explained how you do that outside of the syndicate model that now exists, though.
Yeah, I'm sorry, say it again?
I said, you never actually explained how you would do that with. Like,
How he explains or how I explain?
Well,
You, right?
I mean,
Either one.
in his book, Calcanis says,
Oh,
you know, people
right.
should do 1 to 5K syndicate deals, but, you know, back in the time when he's talking about where he would be, you know, putting a couple K into an angel investment, I mean, there wasn't any model to do that, so it's a little bit of a, you know, so it would have been a little practical.
Well, but he knows what he knows now, because it was only available now. Reg CF has only been available for a year and a half, you know, so. I mean, and that's where you're kind of in effect syndicating with the online world, because if they've done the right due diligence, through whoever is supported, like a seed invest, then you are syndicating with all those people that are investing in it, right then. You know, you just don't know who they are. Go ahead, grab a seat. Might have to go grab some more chairs here, it keeps filling up, so good. All right, so, one of the things, I had to do this, and because, you know, ICOs are such a hot topic. So you just gotta move, because you gotta cover it, right? It is something that people are considering as an investment strategy. So, you know, real quick, I'm just gonna go over it at a real high level. You know, you got cryptocurrency. I wanna assume that everybody knows the foundations of this stuff, and I don't have to go into a lot of detail. Is there anybody that doesn't really understand anything about ICOs and cryptocurrency? Okay. All right, good. I didn't want to put you on the spot, because you can always ask me afterwards, right? But anyway, I'll go back to the live stream and put the question in. So, okay, cryptocurrency really pretty much came around, you know, 2010 was when Bitcoin came out. There's over 700 of them now. These are the leader ones that you would know the names of. You might be, if people would be investing in those things. It started, the whole purpose of it was a decentralized peer-to-peer financial exchange. Right, that was, you know, it was really right when we were having our monetary crisis, and the banks were questionable, and some really smart guys, you know, developed this blockchain, so you would have this way to verify who was the owner, and who was the seller, and who was the buyer of the crypto, and it was a peer-to-peer financial exchange. I have a company that I had my angel group had invested in, and I have some shares in, that was doing that before there was cryptocurrency. In what they call bit minutes. He was doing a wire transfer, zero cost wire transfer, and people would transfer with cell phone minutes. And then he now has turned it into an ICO, but it's, you know, he was doing this kind of stuff early on as part of one of his strategies to be able to transfer money outside of like a Western Union. The thing is that it gains value as it's traded versus an intrinsic value of the offering itself. When you're dealing with real estate, when you're dealing with stocks, when you're dealing with private stocks, they all have some value in what it is that they are creating, or what they have created, or where they're going, where that just doesn't really exist within the crypto space. One thing, and I'll talk about this, mining farms is one of the areas where if you wanted to be in the crypto business, I'd invest in a mining farm, because no matter what goes up or down, it's getting mined. It doesn't matter what the value of it is, it's getting mined. And they take a percentage off the top, right? So, okay, blockchain has been something that came out of that, but it's now infiltrated almost every industry. So you can still be within the space of technology that's come out of that, within the thing of blockchain. So here's just a kind of a basic list. It's an eye chart that has sort of all the values of, you know, when they first started trading, where their volume is, you know, all the different kind of things, and where they're going, whether, you know, all that. So it acts like a stock market to a large degree. Ed Cooper from Revolut Exchange stated that the massive spikes and troughs are fueled by speculation. The swings are fueled by speculation rather than technology advances, and so many people enter the space drawn by the price headlines only. And you have proof of that when you start to see the ups and downs of when you go through these main coins. And I'm going to draw your attention to this little spike right here. So here we go back to 2014, deep, 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 deep. And all of a sudden, because it's the news and it's feeding on itself and it's a trend, it's going to be something like when we go back, when you look back, a lot of y'all are young in here, so I can't use too many old examples, but, you know, some of us talk about VCRs, or when we didn't have, you know, or y'all don't have kids, so y'all don't remember the Tickle Me Elmo craze that went on for a while. Or what about the rock, right? The pet rock, that everybody had to get a pet rock at one point in time. 10 years from now, they might, I'm not saying for sure, but they might be talking about this craze, right? And you go to Bitcoin, same sort of thing, right? It's all just like, but see how it spiked? That's all the people getting in, and then all the people that had made, that invested back here started selling and monetizing their investment, right? So this is from today. Bitcoin price, latest updates, cryptocurrency threatens to fall to 7,000. Now, that's not a bad deal if you invested here, but if you invested here, that's a bad deal, right? Okay? And so that's his website, if you want to go and look it up. It's a really good video on there that sort of talks about the history and kind of the trends and stuff like that on that particular one. I just searched on Bitcoin trends today, and that's how I found it, so, you know. So he talks about, it started out at 7 cents, and it has peaked at 10,000. Now that's a big upturn. But the problem with a lot of these kind of things, because we'll see here in a second, stock market goes up and down, and all this stuff goes up and down, but you got to predict it. Right? Warren Buffett says, when it comes to Bitcoin, he wants to make one thing clear. Unlike buying stocks, bonds, and real estate, buying Bitcoin is not an investment. That's because it lacks the intrinsic value. And if you buy something like Bitcoin, some cryptocurrency, you don't have anything that produces anything. You're just hoping that the next guy pays more, right? You aren't investing when you do that, you're speculating.
Warren Buffett also, he's an awesome investor, but he also missed out on Google, Facebook.
Oh, he doesn't really do any kind of private
Yeah,
stuff.
he didn't do any of the technology.
I use a lot of his in the, one of the things I advise people when I'm advising them about angel investing is to invest in what you know. One of the things he says, and invest in what you know.
And he's clear, he's like, I don't know technology, he doesn't even look at it.
Yeah. So so a lot of times people,
Except Apple, he understands that.
yeah. So,
He also has a lot of cryptocurrency is a pretty big risk for him too.
Yeah, yeah,
Right.
it's
Like,
eating with, exactly.
Yeah.
Why is that?
well, it's interesting to see
he
with,
has
I want to see
dollars
somebody
in
do,
traditional money that would be.
Banks aren't gonna be disintermediated anytime soon, they're already creating their own alternative.
yeah, and I think that one of the things that I haven't seen any kind of correlation report on when the stock market takes a dip and how it correlates with what's happening in Bitcoin, because you have, large speculators and, other money houses that have probably, particularly on foreign soils, where it's much more recognized as a currency than it is in the United States, that could impact that when they sell one thing to offset a loss in another place, right? So anyway, it's the whales. The thing about the whales is that I saw this stat, and I think you were in on that meeting when we talked about the cryptocurrency, Graham, right? When it was that 90% of all the coins are held by like 100 people. It's like
Probably a few less after the decline in price.
yeah. So, but it's like, and so they have sort of like this syndicate of like allowing each other when they're going to sell, because it's the insider thing, because they know it's going to affect the market if they start to sell. And so they have this big thing where they're trying to keep the market somewhat stabilized, right?
Wow.
So, okay, bringing it back. Here's what we're talking about. Last night, I was at this thing where they were talking about creating residual income from being an internet marketing affiliate. And the guy started out his thing, he goes, yeah, he was telling his story about how he was dirt poor and he, was worried, he was an unemployed union carpenter, and so then he started investing, and I was waiting, what did he say he was gonna start investing? And of course it was real estate, right? He went to a real estate course, he and his wife were like, oh, should we do this? And he's like, well, I could, do it all myself, but I don't have enough time. And she's like, she heard the vision of managing the investment, and she's like, I'm taking charge of our financial future. I'm going to do it. So they started investing, right? And then you got some people will say, oh, I left my job to gain independence as my own boss. They wanted to go and become an entrepreneur. There's a great book. If you ever think about that, I suggest you read Michael Gerber's E-Myth Revisited. Talks about going to become your own boss and really what that all means, because sometimes it's not as glamorous as you think. I took a class to learn how to invest in real estate in my spare time, right? You hear those kind of things. Is what I think. I signed up to be an internet affiliate marketer, right? It all comes down to this. Everybody familiar with Robert Kiyosaki's cash flow quadrant? So, right? The thing about it is that employees are employed by somebody that at some point in time was an entrepreneur, or is an entrepreneur. If it's a public company, maybe not so much, but, right? Then you move over here into self-employed, and that gets, you have a job and you're independent, but all your time and money is tied up with each other. Robert Kiyosaki teaches you want to get to a point of being a business owner where you are, having a business that works without you being there. It's independent of time, it generates money. And then ultimate goal is to get to be an investor. Where you're investing in multiple businesses and multiple real estate, things that makes your money work for you, right? So, let me step back, tell you a little bit about why I'm up here talking to you today, because I haven't done any real much of an introduction, I gave you a few nuggets. So I've got this thing that I call the compassionate capitalist movement. About a decade ago, I started this term when the recession was going. I had a radio show that I called Southeast Private Equity Spec Radio. It's called. We used to run a big private equity event, and the companies would pitch to angel investors and VCs. And when the money kind of started drying up, it was on the sidelines. I said, we just got to get people to put money back into the market, into entrepreneurs, because that's where the jobs are created, and let me call it the compassionate capitalist show, right? So I started the movement back then, but I didn't really have any platform or means to do it until I came out with the book. So I got my economics degree at Emory, and I got my MBA from the University of Florida. I worked for IBM for 13 years before I left. My last job there, I was one of those entrepreneurs. I brought products to market. My last job was the deal maker, where I was working with all these young reps in the call center as somebody that my title was Complex Opportunity Business Manager, but all the .coms were coming into us, all of the brick and mortars going to click and mortar, all the new innovations in wireless technology, they were all coming in through that because IBM considered them small business. They didn't have a mainframe, they were a small business. And they realized that they were missing out on the Amazon and the eBays and these guys of the world because they were standardizing on somebody else's tech. And so they wanted to get them in earlier so they could be on those up and growing companies. And so I was a person that worked with the .com kind of folks to make sure that IBM blessed their technology, that you could go out and get venture capital money and come back and spend it with IBM. I thought I knew how that market worked. I was in my own little corporate bubble at the time, because just to give you an idea, I left in January of 2000. I mean, have you done any kind of history lessons and finance classes? That was probably almost at the peak of the .com right before the collapse, right? But I had this one company that had amazing software tech that was going to change the world, and even though he was a difficult CEO, I had decided that it was worth it. I was going to go, I could control him, and I was going to go and take him to the market, because I've been doing a lot of product launches, and I was going to go get him money, right? Because that was what I knew. And first of all, I learned the first lesson. A difficult CEO will have a difficult time building a company, and will have a difficult time getting money. And if ego gets in the way, it's the old adage of, do you want to be a rich founder or a poor CEO? And so he is still, to this day, is a poor CEO. So, but I had left, right? But across that, I discovered angel investing, because I was checking out this angel investor group, Network of Business Angel Investors, and to see about him presenting at it. And it looked really good. It was really exciting. It was like all these things. My head was spinning. It's like, oh my God, it's almost like my life has led up to this point. So the founder of that group, it had started in 1994, he was looking for a way out. He wanted to mentor somebody to take it over. So fast forward 2005, I did. And I rebuilt it. It had really gone down after the .com, and I rebuilt it because I came out with a book or a series of small ebooks, because I had this wealth manager come to me one time saying, I can't advise people on investing in angel private deals. And I have a lot of people that want to be angel investors, but I can't advise them on it. Where can they go get information on how to do that? I was like, it's easy. I'm sure there's something out there. There's nothing out there. So I took all the stuff I'd been talking to all these angel investors, interviewing hundreds of them over the years, being a part of these groups, and I had been sitting through all of these pitches, asking people, why did you invest in this deal? Why did you not invest in this deal? All that stuff. And so I turned it into, it was the first 5 chapters, going to be 10, and then things got going, and I didn't get the rest of them written. But back then, ebooks were PDFs that you sent to somebody in email when they opted in, because you wrote a newsletter. There wasn't Facebook, there wasn't any of this stuff. That's how, And so anyway, I built it up to be one of the most active in the Southeast and Atlanta, and it hit Forbes, I think, Fortune magazine's top 50 list in the country. And then, we were off to the races. I had this big vision of where it was going to go and all this kind of stuff that we were going to have, it's going to, and then the recession hit. And I had a model that just really wasn't conducive to, I inherited this old model. By the time I figured out I needed to pivot, it was too late. So I stepped back from all of
This was
that.
an Angel Network, or?
Yeah, that was a network of business angels and investors, NBANI. Yeah,
Does
that we,
that still exist? Or?
no, I sunsetted in 2012. And I discovered two things about it. That I had a lot of investors that were execs in companies and ran their own companies. They weren't independently wealthy, having built some giant IPO or something like that, or a big acquisition. They just wanted to put their money to work in other entrepreneur endeavors. So, but when the recession hit, they had to make sure their own businesses didn't suffer, and so they didn't have the time to do what they needed to do to be an angel investor. And so I realized that there was a lot of companies that were in this kind of a capital abyss, where they may have raised an angel round, they got to a few million in revenue, they took them a few years to do that, so they were too far along for traditional angels at that point, too slow growth for VCs, and not big enough for private equity funds. Where do they go get money? And they needed to raise, let's say, $5 million, so they could be a $20 million company instead of a $5 million company, because they had all this products they wanted to come out or expand or something like that. So, Jobs Act happened. And there was rumors coming that it was happening, right? And so that became the vision for the future. That says there really is the barrier between entrepreneurs and investors has been removed. Now, the goal of it was to make it easier for entrepreneurs to get access to capital. But if you don't follow that up, like on the real estate side that I showed, where investors learn how to invest in the companies, then you have what I call the great experiment will fail, right? All it takes is a few people to get out there, lose their money on crowdfunding campaigns, or do this thing, and you get some bad press, or on an individual basis, somebody does it, and then they go and they tell their neighbor, and they tell their, people in their whatever group, oh, that was the worst thing that I should have ever done, my account was right, and they just went about it wrong. They did it based on a cool video or something, without understanding what it takes to really understand how to invest in companies. So I came out with this book that is sort of the primer for that whole process, and has a resource portal that gets you all kinds of stuff to be able to make that transition. So I'm doing the compassionate capitalist movement. I talk about it because in two ways. It's a person that invests knowledge, resources, time, and money into entrepreneur endeavors to bring innovation to the market, create jobs, and create wealth. That was my original definition when I first changed my radio show that, and I started this, because that was, I felt that was what a lot of people did. That was a lot of the motivation for angel investors. And then I also realized, because of that target market, there's executives. The guy that I talk about in the book was the making of compassionate capitalist. I think I call him Joe. Anyway, he was a guy that was the CEO of a foreign-owned, large company in the United States that had, he was at the top of his career, and he was bored. You know what I mean? He was 40-something, and he had kids in high school, but he was like, I keep thinking about wanting to go start a business. Right? And today it's funny how you have these magazines that come out, and on like every other magazine will have, starting a business at 50, and all this kind of stuff. Entrepreneurism is the new black, whatever. And so, they don't. So I decided that you don't have to be. We need more money in the marketplace for entrepreneurs, and you don't have to be an entrepreneur and incur 100% of the risk and 100% of the time, and take time away from your family and all the other things that have to happen when you want to be really committed to being an entrepreneur. You can make money if you find an entrepreneur that has a strong passion for a company to succeed, and that's where compassionate capitalists came from. So that's my second definition. So the Jobs Act, I talked about this. Barriers are being removed, right? It goes both ways. It's I mentioned it earlier, greatest opportunity for economic democratization of the capital markets. The public way for investors and entrepreneurs to connect on an equity base, in case you didn't know, there's 4 ways. Intrastate, that's where you're located in a state, and you can sell to investors in the state of any income, okay, accredited or unaccredited. Does everybody know what the accredited investor means? No? Okay, I'll come back to that. Interstate, so Georgia, they uplifted it to $5 million. You can raise up to $5 million in the state of Georgia in a year from investors in Georgia. Okay, Reg CF, also, anybody can invest. It's based off of income more than anything, I don't talk about that. Reg D 506C, only certified accredited investors can invest, okay? And then Reg A plus is a national basis, and I'll talk, I have a chart, I'll talk about this.
What does certified mean?
Certified, so on a 506C, okay, so accredited investor, basically the basic definition of it is on an individual basis, you make $250,000 a year or more, and typically they look back 2 years on that, and you have $1 million in assets or equity that's not your primary residence, or it's $350,000 as a household income, okay, and the other things still apply. So that's the accredited investor. Traditionally, anybody that's been investing in companies, they just typically sign an investor questionnaire. It's a couple pages, and you check off what kind of entity you are, you know, an individual like that, and you sign it, and nobody checks it. The entrepreneur raising capital goes and sticks it in a drawer in case the SEC comes knocking. That's really the whole reason, because you're not obligated to prove they're an accredited investor. They say it, they sign, they must be an accredited investor. A 506B, which is the alternative to this, allows for 35, traditionally it allowed for 35 unaccredited investors.
Are these like
as
types of forms, types of companies? I'm not.
Okay, but these are, okay, good, I'm glad, I like to talk about this stuff, so I'll go.
So certified means you.
So
actually
certified
use
means,
use
there's
like a
3 ways to get certified.
Third party.
You submit your balance sheets of equity and, you know, assets and liabilities yourself, you know, full disclosure. Or you submit your W-2s, you just qualify based off of, you know, off of an income statement like you would apply for a mortgage, okay? Or you have a, some professional, you know, vouch for you, lawyer, accountant, financial planner, okay? And they can write a letter saying this person is an accredited investor.
And what does that get them?
That means that they can participate in a 506C, okay?
And what's that?
So anybody can invest, not easy, but not without risk. Oh,
So like I said, I'm confused on what barriers were removed. Like what, I know you said
Okay.
entrepreneurs invest, like what is that, what do you really mean? Is it just, it makes it easier
Is the
for
506C
people
like a
to do
type of
investments?
company?
okay, so, all right. Prior to 1933 and the Securities Act of 1933, there was no such thing as a private company, so to speak. If you were raising capital, you had to be a public company. And when the stock market crashed, the powers that be, the Biltmores, the DuPonts, the Gettys of the world, they went to the SEC, because the SEC was formed the next year, and they said, we need to have a way that we can invest in private endeavors without having to disclose all this stuff.
Oh, gotcha.
Okay, and so they wanted to not have to disclose like a public company. So they came up with what they call the Reg D, okay? And within the Reg D, there's a 504, which still exists as it is. Actually, that's how I think they do the interstate, is on the 504. You had a 505, which nobody ever uses. 504 is up to $5 million, 506 was any amount, and you could have some number of unaccredited investors. And then the other ones are dealing with terms and conditions of being an
So
investor.
is it a set of regulations? Is that what reg stands for?
Yeah, reg is regulation, D,
Okay,
right?
okay.
So that's where this is. So when the Jobs Act happened, and Regulation A had been out there, and Regulation A was primarily used, and it was like $25 million was the max. It was primarily used for private equity funds and hedge funds and things like that, and people raising money on their bonds. And you could do, the whole idea behind that was that you could do general solicitation. So the big barrier that had been there before is that companies couldn't advertise that they were, you know, raising capital. So you had the impetus for the Jobs Act, besides the economy, was that this whole, you know, Kickstarter, Indiegogo, all this stuff was happening where people were crowdfunding, and it was 2 ways to do crowdfund, right? Rewards based, where you were in advance sell on something, or a donation. Right, and that was 2 ways that you could raise money on a crowdfund. You couldn't give equity in your company. And so they said when the economy hit, well, here's all these people, then some of these companies, because when you look at, and I talk about in the book, like the watch company, right, Oculus, you know, all these different ones, they all got their first money through crowdfunding. But who got to, nobody, none of those people that gave them that money get any of the equity of what these companies became. They got rich off of it. It wasn't until they got big enough that the angel investors got in and the venture capital got in that they, you know, people started making money off of those companies, right? So there was a lot of examples of companies that had raised big money that people didn't get to pay in. So the marketplace said, okay, Congress, you've got to let people, if we are going to, people aren't saving for the future, they're not investing in their 401ks, people don't have jobs where they've got 401ks, we're in this gig economy, we got all this stuff going on, you've got to give them a way that the people with $100, $1,000, whatever it is, can start investing and have a piece of that entrepreneurial dream of the American pie entrepreneurial success, right? And so, they said, they came out with the Jobs Act, and within that, they created three types, type 1, type 2, type 3. And don't quiz me on which one is which, I might get it wrong. But out of that were these things. So now Georgia, for example, and Kansas had started the interstate prior to that, because they used a little known thing within 504 that allowed them to do that. The big thing with Reg A was that you had to register with every state. You could advertise it 6 months in advance of it, but you had to register, it was very expensive to register with every state. Yeah.
So just so I understand, the interstate one for Georgia, I could raise up to 5 million from unaccredited investors, that's what.
And accredit, anybody. So the way they judge it now is that if you make under, they kind of, the no man's land is, you know, under the 250, the accredited, but they basically kind of say, well, if you're under $100,000, you're not accredited, then the maximum you can invest in a year is 10 grand. And the maximum you could put into an individual company is $2 grand. Okay, so they limited it based on that to limit the
As far
amount
as
of
like
money.
what you can report on like your taxes, like what is, so like if I were to say if I made, you know, 50 grand and I decided to put 25 grand into different types of investments, that is not legal is what it's saying? Is that like that, is that what you're saying?
Well, you could go into a Reg A plus, well, Reg A, yeah, same thing with
So
Reg
like,
A
so
plus.
these
So
are- so
you
these
could
are
go
types
into a
of relationships?
506, you could go into a 506B, where they can have up to 35. So you got somebody you know, and you just sign the, or what a lot of investors do, they just sign the paperwork.
So the paperwork being Reg D 506C.
No, that one is a certified, there's a 506B in that anybody can, that signs the paperwork can be. And it can be, it's unlimited as
So
well.
these are like entity types.
These are offering types, these are
Well,
regulation,
Seems like
SEC
you
regulation.
can only buy in if you're certified.
If you're certified.
I
you're
thought-
On a
Like
C.
an entity type.
Yeah,
I
okay.
thought 506B, everybody had to be accredited.
It's a 35, I believe it's a
So
35.
like a
but
company would
that
be-
accounts for.
So a company would be-
You don't have to.
506C,
And then A is
everybody
like a
has
type
to be
of company.
accredited.
No, it's a type of
Regulate.
regulation.
Like, yeah, I guess I'm struggling on how these four relate to how I can invest. Like, I understand you're saying I can join a Reg D, but what does that mean by
Okay.
joining a Reg D?
Let me, I've got a chart, I can either jump forward to the chart, or you can just hold that thought for a
I'll-
second.
yeah.
Hold the thought, let me I'll go through this other piece of it, right? Y'all have a hard stop at 1?
I think I'm voting until 2.
All right, so, because I come back to it to talk about how you invest in them at the end, okay?
We'll let you keep going.
Okay, y'all are doing great. I love the questions. I really love the questions, okay? So the takeaway on this is that every state now has an interstate, just about. All the rules kind of vary. Reg CF is up to $1 million on a national basis. 506C is unlimited, and Reg A Plus is up to $50 million, and it's a backdoor into being a public company. So a lot of times, 6 months later, the company's a public company, okay? So.
Okay.
Real estate investments, right? These are what people know. Rehab, flips, buy, fix it, sell it for a one-time profit. There's investment property, residential, commercial, rental. You've got,
Can I ask a quick question on your previous slide there?
okay,
Is the Reg A Plus, is that like secondary shares for like an Uber or something? Is that the same thing or?
not really.
Okay.
Those X platforms, I think they call them. There is a way that people, because an Uber would go totally public, but they sometimes they go secondary because they've owned them long enough. If you own your shares 2.5 years, I think the number is, then you have the ability, and anybody watching this online, if I'm wrong, you can tell me and that's okay. If you do it 2.5 years, you can sell your stock to somebody else. And so that's where some of these ones that are long-term, they created these alternate exchanges for that kind of stuff, and they're still considered private stock, they've just been a private transaction between people. On a Reg A Plus, you have to file accredited, the financials that a public company has to file, but you don't have to do all the rest of the paperwork. And so they give you 6 months to complete that, or you can just stay private. But anybody that is an existing shareholder, so that's where they kind of all start fitting together. Anybody that's an existing shareholder that participated in a different round, they can sell at the same time that the company is selling the Reg A plus. Yeah. Okay, you got, so your average on diversification on real estate is 10.6. This is off of the stock, off of the internet. 11.8 on REITs, right? The average analyzed return on the S&P is 11.6. You got 8.6 on this, right? Market fluctuations, they go up and down. I had another chart on that, it didn't come up, but anyway, so what you looking at? 11.6 on this, right?
Yep.
You got 8.6 over the last 20 years. You know, market correction is when it's considered, when it's gone down over 10%. So here's an example of our stock market, and I should have gone and got an actual thing so you could relate it to the Bitcoin ups and downs. But in 2008, the S&P 500 lost 37%. If you were just investing in an index fund, so obviously not individual stocks necessarily, but $1,000 at the beginning of the year, that would have lost you 370. And you'd only lose it if you sold. Right? That's the whole thing about that stuff. It's all virtual losses, but you gotta wait for it to come back up, okay? So, but it can take years to do that. So in 2008, yeah, you started with 6,030. In 2009, it gained 26.5. That puts you back up to 797. In 2010, you get back up to 917, and it wasn't until 2012 that you would be back up over your $1,000 original investment, right?
Yeah.
And so, you know, you're kind of looking at 1,000 less, right? In 4 years to get back to their original investment. So I compare those because of the angel investing. Now, full disclaimer, very risky. That's why if anybody knew exactly how to how to pick this perfect private equity stock, the VCs would always get it right because they are the ones that have all of the resources to figure it out, right? And they're the ones that came up with the formula of the 10 companies, right? So you got to have a plan that you've got to invest in 10 companies over whatever period of time based on your income and disposable income and stuff like that. And the idea is because you've got 3 that are gonna totally lose all your money. You're not gonna get a penny back out of them. You're gonna have 3 that will do, you know, okay, there'll be a base hit, they'll go and sell the company and you'll get some return on the company. More companies are bought than go public, right? Then you'll get 2 that will do really well. They'll have grown big enough that they got bought by a much bigger company at a bigger multiple. And then you'll have one that's an IPO or something that hits it out of the park and makes up for everything else, right? To get to these kind of returns that they're talking about. So the average investor return, they say is 2.6 times in invested capital over 3.5 years for investment to exit. And that's with a lot of times the ones that are kind of considered the base hits, okay? An angel investor will achieve an average 27% internal rate of return. And the most experienced angel investors, they expect no less than 31 to 40%. So that's where they're looking at the financials, they're doing their math on the valuation, what they think that they can do when they analyze the financials on a company, and they think what they can sell. I mean, I've had investors in my group that would say, love the company, totally think they're going to be successful, but their valuation is so off, there's no way they can sell it for what they have to do in order for me to make my internal rate of return. And so that's a lot of times people will walk away. And so part of being an angel investor is discipline to walk away from something that you emotionally think is going to be a big win, right? I'm still learning that lesson. I haven't totally lost all my money on the things I've invested in yet, but you know, I'm still waiting. I got fingers crossed on one that's supposed to happen this year.
So I know that the 2.6 times, that's just the general for average of all the good and bad. For what are the investors looking typically for a 10x return?
No, so that's
5x return?
that's the ones where they think that they're doing pretty good, right?
The ones that are high growth opportunities.
The 10x is the one that makes up for just the 2.6.
So I mean, is that what they're looking for when they're looking at proposals, the 10x number, right? They look because they have a lot of money. They can't deploy in a billion different investments. They gotta. Right. They have a big fund they can deploy into a certain number of investments.
Yeah.
I think
You would expect for them to think that it would have growth potential if they put the money in, right? Like what they're looking for is speculation, but they're obviously looking for a return.
Right.
Yeah, but I think they don't even look at the ones that aren't a certain X. Like if it's a 3X, it's not even.
Well, it depends on the kind of investor you want to be,
Yeah.
right? Because the whole idea, like when you get to a Reg A plus, the odds of having a 10x on something like that is low. It's just like when you buy stock. It's very difficult for a public stock to go 10x. You know what I mean? Because it's incrementally growing. And when a company, when you're at the highest risk is when they're a startup and don't have a validated business model, you know, that says they know how they're going to generate revenue or they have generated revenue. The further you go up the value chain of where they are, they're not $1 million valuation, you know, they're something bigger than that, you know, but then because a lot of the ones that you call unicorns, these are the ones that have the $1 billion valuations, they're a $1 billion valuation because the money that got put into them, not necessarily because they actually have a market cap right now of $1 billion, which is why they struggle when it comes time to go public, because how do you go into the marketplace with that? That's what Snapchat had a challenge with, right? I mean, they tried to go in there to establish, you know, a marketplace there, but they collapsed because their business model didn't support it. And even after Facebook went public, it still took them a long time to really get to their true, you know, rolling, you know, because all the ad revenue thing kicked in, right? So they got to a point that their market cap caught up to, you know, what their revenue and what their traditional models and measurements were. So, you know, but the thing that you have to understand is when those kind of things happen, even that very first one, I mean, the first people that invested in Amazon invested at 15 cents a share, you know? So this is Bitcoin territory, right? But you're investing at something at the very bottom of its potential. That's where all that multiple comes from. So even if they got to be a company that you think about the guys that built Tech Village, their first company was what you would call a base hit. You know, they sold it for a 2 or 3x, right? Then they took their money and they went and did another business. They sold that for a little bit more, right? Until they got to a point where they had gotten momentum enough on their third or fourth deal that they could go take down a building like that and build what they've done over there at a technology village, right? So, okay. So the secret is buy low, sell high, right? The same thing you want to do in the stock market, same thing you want to do in real estate. This way you're just playing it with private equity. So we're talking about 260%, just so we know, understand that, right? Buy, sell, low, high. Okay, angel investors, all sizes and styles. So the idea is that there's different reasons why people become an angel investor. I talked about Joe reaching a pinnacle in his career, wanting to, you know, put his money out there in different places. Sometimes it's an investment appetite. Oh, I can save and I can make 3% or 2.5 or 1.9 on my money. Or I can invest for the future and say, you know, what if I can just be saving in something, and it's nice to have a, you know, a 401k that your company matches, but if you don't have the benefit of that, then, you know, or build up a nest egg through a self-directed IRA that's after tax, and then you can invest in that into these private companies, and whatever returns go in tax-free, right? So there's things like that that you're invested in the future. Or you just decide I want to be a compassionate capitalist. I was watching a show last night, and it was about this solar-powered plane that went around the world. It was on GPB and Nova, and it was really fascinating. I have no idea what the revenue model is, but they totally had to raise a lot of money to do that. But that was where somebody was like, this kind of technology, figuring this stuff out, solving this problem, can change the world in a way that we don't know, but haven't thought about yet. Same thing when the first electric cars came out. None of those are still on the market, right? Yeah, it takes innovation and evolution of innovation, and sometimes compassionate capitalists do that, so they can be a part of that. And hope to get the base hit, because that tech gets bought by another tech. Okay? You can be an active investor. A lot of the traditional angel investors that are part of angel groups want to be involved in the company in some way, somehow. But not all of it can be. That's not, you have to be, there's going to be a point where you're the passive investor. Sometimes they have, like on these syndicates, there's a lead investor that's going to be the active investor, even if it's just on a board. And then you have all the other passive investors that play into it. But on a public stock, you're a passive investor. You don't really get a say. You get to vote, you know, and you still get to vote. You get to vote with private companies too, right? And so, you know, you have passive investors. Anything that's done on a public exchange, Reg CF, 506C, intrastate, Reg A Plus, all of those investors are passive investors. Okay, just so you kind of understand that. You're just one of many when they're raising capital that way. Seed stage versus growth stage. So seed stage is kind of what you're talking about, where you get in there and it's 50 cents, $1 or less, whatever for a stock. And then a growth stage is somebody that's already figured out their model. They're taking their model now, and maybe they've been selling software to hospitals, and they're now going to go and turn around and sell it to you know, an insurance company or something like that, and they need they need a new sales force, they need to expand, they need to do some R&D, and they have a growth strategy. And those are the ones that I talk about that fall into that gap where they don't fit for private equity funds, or they're in an industry doesn't fit for VCs. You know, it could be a consumer products that you like and love. You know, there's a reason why there's some of these shark attack kind of angel TV shows, right? There's even one now where it's outdoor stuff. So it's people that are inventing things that are outdoor things, and the VCs in that case are people that have become famous being outdoors people. And so, you know, but that's the kind of thing that an average angel group or the average VC is not going to invest in. Those kind of things can be part of a growth stage as well. The ones where most traditional angels have fallen in is what we call market makers, right? They're investing in companies that are creating a market. It's a whole new way of doing things, a whole new way we haven't thought about. It could be a new business model, like all this crowdsourced stuff that you have with a lot of, you know, the Etsy's of the world or the Ubers of the world. You know, it's all these things that are creating content from other people and they're not paying for it, right?
No, I'm just adding my company in that list.
Right? Business, you know, and they're business angels in that they are in the business of investing. So they have carved out a certain amount, they carve out a certain time, just like you get serious about real estate investing, you get serious about investing in this and bigger things. And this is where I come into the accredited and unaccredited side of that and deciding, because that can kind of dictate, you know, the types of investments that you're allowed to participate in. Okay, so types of investments, way to be an angel investor. You can get started one way. Sometimes there's people that, one of the investors that got my book called me and he said, you know, you really need to do this. He says, I'm working with this company and we really would like to have an accountant and a web designer and these people do some work for equity. And I said, yeah, it's in the book. It's called Professional Angels. And these are people that are professionals in their field of expertise, and they are, and they have reached a pinnacle of success enough. There's an app developer guy over at the Tech Village that I had lunch with one day, and that's what he does. He had success, and so now he invests time into companies, and they give him a little money, but he gets more of it out of the equity. So it's affordable for the entrepreneur. So you can do that as well if you want to get started and don't necessarily have cash. The other way is bridge financing. Be the bank. So a lot of times, particularly if you're in consumer products, or you get somebody that's in a tech space and they get their big contract. They finally get this contract and they're ready, it's gonna be worth $1 million, right? Where are they gonna go finance that? They need to hire up people, or they need to buy product, and they need to manufacture product, whatever it might be. It's difficult to get that if they're new and don't have a track record. You can get receivables financing on the strength of the person that's buying it, but in order to, you know, front end that, you typically have to get some other kind of financing, particularly on the manufacturing side. You have to have 25% of the cost of manufacturing in the bank before a purchase order financer will finance you. Well, you can be the bank, right? If you have assets and you can guarantee a letter of credit. I was talking to a guy the other day on a way to finance films. And he's got an SBA bank lined up to loan money for a film finance if somebody has a guarantor of an angel investor, okay? And so, you know, there's lots of ways that you can get started. So when somebody does that, they don't necessarily get liquid in their cash. They use their assets to secure it, and they get a piece of equity. They get money paid back, and they get a little piece of equity out of it as well. Then there's royalty revenue financing, and that's where somebody is in a fast growth mode, and maybe they want to get equity over and beyond what they could do in financing, these alternative financing means, and you share in the revenue, okay? So that you would pay out, say, 5% of your revenue to all these investors until some multiple. They don't own equity in the company, but they get a multiple on their money, okay?
Owned in stocks.
And once it's all paid back, they walk away. So certain types of investors that are in that annuity thing, they like the real estate flips and stuff like that. They want to have rental income. They understand that model. So they're basically getting a check on it every quarter. This is the way most of your spec on oil and gas is done, is in that thing. As it starts to produce oil, they pay them out and then they're gone and then it's done.
There's a cap. I didn't realize there was a cap.
On royalty financing, it's usually 4x.
Okay.
you do 4x. Now, if you're investing as equity as an LLC, then you're gonna get a share, but they may defer that, and there's, it depends on what your terms are. Then you got the convertible note, is a traditional one that people have used up until the last couple of years when safe notes became popular. As an investor, I would tell you, there's a lot of, I had pulled up a couple of charts on it, and I thought that, some samples, and I thought originally that a safe note was just a less encumbered, simpler version of a convertible note. And then I started seeing some of these things, and a company was pitching at 1 million cups that I'm a part of down in London, and one of the guy that runs it says, "Hey, Karen, I'm thinking about investing in this company. Will you take a look at this offering and this safe note?" And I said, I don't really see a value to an investor on that. Here's the reasons why I don't like the terms of this deal, and because sometimes a deal will die just because of the terms, right? And that guy had some lawyer had given it to him, and so a lot of times entrepreneurs will try to protect themselves, so they'll do these things that artificially create how much shares that they have, or try to, and they don't even realize that they're shooting their selves in the foot when it comes to raising capital. Because the thing about an investor, you have lots of options. There are so many companies raising capital. If you're patient and you understand what you're looking for, I have a thing in my book, it's a business model, how to set that up. Just wait. The money doesn't have to burn a hole in your pocket. I always tell companies is that when you're looking for capital, you have to understand that you have to be the reason why they will take money out of some investment that they've got to put it in yours, or choose your deal over the 3 or 4 or 10 other deals that they're looking at that time. This is, you've got to be more appealing to them. A company came to me a while ago that had this thing, he was doing a 506C, raise his money, he was gonna do a 12% interest paid back in year 2 on this, thing that his deal, and it was like, why would somebody do that? Who told you that? Oh, this lawyer that does this group, they do 506C offering documents. I'm like, he goes, well, my board said that's what I could afford to pay back. Well, they don't want to be paid back. If they're going to give you the risk, you know what I mean? I just like, he didn't, and I go, you need to go back to your, and you can't even, you look at your financials, you can't even pay that back in year 2. It was just not smart. And so, anyway, so that's a big thing. So the safe note, there's like 5 or 6 different versions out there. So somebody comes, don't just assume the safe note is favorable to you. Yes, it was intended to be where it's a simple, I forget what it stands for. Anyway, it was just intended to be to get away from the conversation of what the valuation is going to be. Now and where you would go into the next round. But what's happened, and this is where there's articles about this, where companies have done sequence after sequence after sequence of safe notes without ever setting a value. And so now the one this guy had a cap. It had an artificial thing of $5 million on the valuation. And so they were going to be converting in at a very small share, but there was no guarantee that they were going to be able to raise that next round of capital. And so the thing about convertible is that it does go on, challenge to companies, that it does go on the banks on the books as debt, but it has, a little bit more tangible teeth to it. So just be aware before you start, look at all that kind of stuff. So straight equity is Reg CF, right? So that's crowdfunding. There's portals. Here's the thing. Reg CF has to go through a licensed portal that is governed and regulated by FINRA. FINRA are the same people that regulate the broker-dealers. So they are on the hook. Those Reg CF companies are on the hook to make sure that there's no fraud, intentional fraud or unbeknownst fraud going on, that the company really has the ability to launch a company, do their product, do whatever, right? And so, because the same way broker-dealers, now broker-dealers have steered away from private equity. That's why wealth managers and investment advisors don't do startup companies and stuff like that. It's very hard to go through a broker-dealer, which is one of the reasons why they did the Jobs Act. And part of the reason why they did that is because they have to treat everybody equal. And so they have to spread it out over such a far and wide thing. It has to be a company raising a lot of money, and you can't raise a lot of money unless you got a decent valuation, right? And so the mathematics didn't really work for broker dealers to do it. So the good news is, Reg CF, up to $1 million in a year, anybody pretty much can invest. There are some limits, they will ask you your income and prove your income to control what you want to do on that, okay? Reg A, and there's Seed Invest does it, Indiegogo now has launched one to do Reg CF, which I'm, and 506C, that's under the Reg D. And so I was really, I had not heard that, and I was talking to a company yesterday that is doing, but she's doing one, and I find it hard to believe she's offering $100 on a Reg CF, but they don't get paid until she sells the company. They convert when she sells the company. I'm like, well,
What if you never sell?
yeah, why wouldn't you want them sharing in your revenue now, you know? So I thought that was kind of odd, but anyway. And so then Reg A Plus, so let me give you a couple of success stories on the Reg A Plus. So, you know, give you an idea of the kind of companies. So there is a company called Brewdog. Any of y'all drink beer and heard of Brewdog? Okay, so Brewdog was a UK company that they'd raised their money over there to launch their company, do all that stuff under the crowdfunding platforms in England. They decided to, and Bankroll America was behind them, which is the lawyer behind that. It was one of the instrumental people in the Jobs Act and pushing that stuff through. And so, he ran this campaign. He did a lot of Reg A Plus stuff. And so he was telling us about them coming out and doing it. So one of the secrets is that they never really spent much money on marketing because their idea was to get shareholders to be their fans, right? So it was what they learned so they did a Reg A Plus offering to build a refinery up in, a brewery up in outside of Detroit, and then ultimately we're gonna open up small brew houses around the country, right? So they set out to raise the $50 million. I think they raised $8 million. But the whole idea is that whenever anybody gets it, and the minimum investment was like $200 to get into that. Or they get like one share or whatever the combination is. And then now you got all these people that when they get, and they got beer, okay? They get like a monthly shipment of beer or something, I don't know. And so so the idea is that then when the company starts making a lot of money, they'll start getting dividend checks, and then if they ever get bought by a Budweiser or whoever, then they'll have that additional equity, right? So they're getting ready to go out and do another raise under Reg A Plus because they said the difference in America compared to like England is like the size of what, Pennsylvania or something, you know what I mean? It's small, relatively speaking, to the United States. And the United States has really varied interests depending on coast to coast in the middle of the country. And so the messaging that you do in different places is different. You know what I mean? It's hard to get the message out. They've gotten it better. I think they're going to do a lot better on this next round, right? The other one, everybody here heard of Chicken Soup for the Soul? That book, right? However many hundreds of books that they've written and all these different stories and stuff they've done. Well, they wanted to create a war chest for doing movies and entertainment. And they needed to raise a bunch of money. They raised $35 million under a Reg A Plus. The smallest was $100, sent out to all their fans, right? So now all these people that could just invest $100 have access to this going forward. So those are the things. So here's the chart that I told you about, right? So you have Reg A 1 and 2, right? Reg A 1 is still 20 million. But there's some limits on how you go about raising the capital on that. You still have to file with all the states. And then you got Reg A Plus, 50 million, but you have to file with the SEC, okay? Then you got 506B, which is the old way that you were doing it, with accredited and 35 unaccredited. And then the 506C came out in 2013. There's no limited. And notice here, there's no broker. You're not required. They are required to go through a transfer agent, and they can go through these portals that they want, but they can also do it within their own website. So when I work with companies, we set up a secure access through their portal. We do the social media and the advertising campaign, and then drive traffic from an interest group, a Warren Buffett model, and then from that find the investors, okay? And then intrastate is under the 504. Most of them have gone up to 5 million because the SEC changed the limit on that and allowed this to be within the way that the states could do it. And then you have Reg CF. So sometimes when you do a 506C, you can't go back and do a 506B, but you can. Some companies are, and this is where like a seed invest will do it, or if you got True Fund, another one. They'll do a combination of Reg CF and intrastate up in like Illinois and Texas. They're doing that. or they can do a combination. Indiegogo is doing a combination of 506C and Reg CF, so you can have those going at a simultaneous time. So they can have one where they're doing bigger with the accredited, and they'll go syndicated on Angel Co. or go out to angel funds to participate in that, and then do Reg CF to be able to bring in some of the smaller investors as well. Okay, so becoming an angel, first thing, buy the book. All right, on the back of that card is on the card is the QR code. It'll take you to Amazon if you want, and I have a couple here today. But the main thing is that you have to decide: are you going to be a direct investor, or are you going to invest with a group or a fund? It depends on how much time you have and your level of experience. Sometimes people will get started in a group or a fund so they can learn more about the process, and they have the benefit of the groupthink that goes along with that. And you have to understand your investor model. That's when you want to get started. I compare like being the bank and bridge financing to kind of like being a flip, right? You're just doing a little bit of money, you're making a little bit of money, and then you're going to reinvest kind of thing like that. And then, or you're going to, what are you going to do? You have to just sort of figure out the industries you want, what's your capacity to invest, because that may dictate the type of company that you invest in, how their offering is done, and have a 5 to 10 year plan that you're going to get at least 10 companies in your portfolio that are private over that period of time, and so it takes patience, right? A lot of the angel investors that I talk to that have been doing it for 10 years, they have 20 companies, 25 companies. Some of them have already failed. Some of them they're waiting to. Some of them have hit wins. Some of them are big. I talked to an angel group out of Alabama that has like 6 different groups down in Alabama and Tennessee. And they said it took us, we didn't make anything in the first 5 or 6 years, and we had a couple of losses, but we're expecting 3 wins this year, And so it takes some momentum and getting some, just sort of commonality there. So you got to allocate a dollar amount or a percentage of your income. I always think every time I say a percentage of your income, I think about tithing. So you're tithing to your wealth if you dedicate a percentage of your income to this, okay? Angel investments, $25,000 to $30,000 is the traditional model for an accredited investor. They're going to put $25,000 to $30,000 in an individual investment. That's the average that they do. So they might invest $100,000 in a year and do 4 investments or something like that, or 3 investments at $30,000. But on crowd-based, then you can go from $100,000 to $10,000, right? You have a commitment to 1 to 2 investments a year. Right, so that's where you just sort of figure out. Sometimes that's the reason why some of these platforms are good, because you do have a group that has done some due diligence on the company already to know what it is, and you can look into it. And if you go look at one of the things, sometimes I'll have like angel.co is a really good one, an angel list, is because you can see. I like to go, if I'm looking at a company on a Reg CF thing, I will go find a similar company on Angel Co, and then I will go find the investors that invested in that company on Angel Co. Okay. And then go and look and see where they are and kind of do an analysis and kind of do comparison. That's what I advise my investors to do. When you see a company or go to a pitch event, if you go to Venture Atlanta and you see pitches, right? Then you need to go out and go to these other places and find similar companies and compare what they've done, who all invested, all this kind of stuff. Are they one-off? Are they going to be a competitor? Do your landscape, that kind of stuff. And that's all stuff you can do at night, while you're sitting on, you're watching, streaming something or binging something that you don't have to pay attention to much, or when you're watching a football game or soccer or something. Anyway, 10 investments. I talked about this. The 3 failures.
Once let's say you're doing all these crowd investments of $1,000 each, is it just illiquid? You can't touch, right? You wait till the liquidity moment, I guess. So each company's gonna have a different.
Yeah.
When we sell or whatever.
Right, and so that's the whole reason why when it comes to liquidity is that you have to think about if you're going to need that money for something, then that's why you go to be the bank, right? And build up your nest, your egg, so to speak, so that you can go do that other kind of stuff, or be enough that it's out of sight, out of mind, right? If you put a percentage away into something, and so you get to like, okay, now I've saved up, $5,000. And you say, well, I don't need a new car, so, let me go and find 2 Reg CFs that I want to put that in, or a Reg A Plus that's further along, right? It's got a business model I understand, and a Reg CF, or some combination thereof, because, when you're going into some of these other ones, they're going to have a liquidity event, or you can go look at, companies like Microsoft. What has Microsoft invested in? They're a public company. It's on their K1s. You can totally look and see every company, and there's CB Insights does analysis on who Google's invested in, who Microsoft's invested in, and go find companies that are like what they're investing in. Go invest in one of those. And you know that company gets to X number of eyeballs, or X number of users, or X number of this or that, then they're a target for Microsoft or a Google or somebody to go buy, right? I mean, those big companies are the ones that are doing this buying, and then you can get your basic.
What's a good rule of thumb? Because I bet 100 might be way too small. To make any kind of, I said earlier, I said 1,000. But is there like a rule of thumb that you like to use and say, I'll throw in a couple thousand every time, put in 2,000?
So, okay, so one of the conservative rule of thumb on equity is if you look at your asset portfolio or your liquidity, what you would consider your alternative investments. And this all is based on your risk tolerance, okay? Typically they're gonna carve out 25% out of their assets, and then out of that, they're going to take out of that, because people are having a balanced portfolio, so in the stock market, where they'll take a chunk of the stock market, they got a big old fat 401k, and they'll leave it in a self-directed IRA, and then they'll, out of that 25% of their wealth, right, then they take, like 10 to 25% of that investment capital and put it into private equity.
But then spread it over, so I guess I got your point. It depends on the situation. There's no.
It just depends on how much money you have,
yeah.
right?
Let's say you had like 20,000 spend, you personally, would you, and you want all do crowd-based investments, would you put in?
Well, see, the crowdfunding ones are probably gonna be, on the riskier side than even like traditional angel.
Yeah.
I would probably take that money, put it in something that would make it a decent interest, and I would, probably only put $1,000 at the most into any given CF.
That's what I was trying to figure out.
Just because if I lose $1,000 out of my $25,000 nest egg, it's not so bad, but I can get 25 companies out of that.
Yeah.
Over a 2 to 3 year period of time, and law of averages says I'm gonna do something with that, that's gonna do pretty good. And so, no guarantees, but, I mean, that's where, and you get smarter along the way, and if you can build your own informal network of people that, this guy knows tech, this guy knows market, this guy knows this, and y'all kind of come together, even if you're not part of the formal angel group, and you just say, like, you get together, pick up some pizza and beers, and you say, what have y'all been looking at this week? And, get in there with your computers and go look at competition, go look. The one thing is people always say, no, there's no competition. There's always competition, because there's the status quo of changing the way people do things. So you want to, go look at it. A lot of times, as soon as I'm on the phone with somebody doing a consultation call, I go Google whatever they think their industry is, and I always find companies that are close enough in that space that they could be competition. And I might eliminate that company because they don't know their marketplace well enough. Okay?
The challenge that I see with this model, or the kind of, non-accredited types of fundraising, is if I'm Evan Williams and I'm starting to, he's got enough money, he just angel funds his own companies if he starts one now, but, these guys, they don't want to have a couple hundred, unsophisticated investors. They'd rather just have, a couple of people write large checks and maybe a couple more with zeros added in a year or two for whatever round that is. So I feel like there would be a lot of negative selection bias where the kind of the crappiest companies are the ones that are raising, crowdsourced money for, breweries or whatever. But if you're talking about like the future unicorns, I feel like those entrepreneurs are going to be a lot more selective with their investors.
So on Reg CF, all those companies go into one single entity as an LLC. And so that's one way that they've carved that out, to be able to, and most angel investor groups invest as a single purpose LLC. So you don't have, when an angel investor club, there's 15, 20, 30 investors in there, but it's one LLC. Okay, and so that's how they mitigate that. And the thought process 2 years ago, totally, 10-foot pole. Angel investors did not touch a company that was any kind of, crowd-based, Reg CF, anything like that. But there's a reason why people are doing Reg CF alongside 506Cs. The attitude has changed on that, because they realize that they can raise this capital this way. It doesn't hurt them because they're carved out on that. And if they're doing a safe note that converts into the 506C, then they can, raising money under the Reg CF sometimes to go raise their 506C and launch a company. And then there's also where, I was having a conversation with the guy over in London that it's called My Tribe or Our Tribe or something like that. I apologize if you are watching this, the Virgin Capital backed them as loans, to provide loans to these companies to pay for Reg CF or Reg crowdfunding campaigns, right? And so as a result of the success that he has done with that, and all these companies that have raised money under crowdfunding and become bigger companies, he's been invited to go out to Silicon Valley and start talking, and they want to start backing him to do the same thing out in Silicon Valley. So Silicon Valley has led the way in angel investing for they're a decade ahead of what we got going on down here in the Southeast, right? They're gonna lead the way. And we may still be thinking that here because of the way we are super conservative in this area, but I think the tide is changing on this, on the way people view the participation in that because of the nature of how they have controlled who can get in on deals and what authority they have on deals. The reason why they don't want to have 1,000 investors in a deal is because they don't want to have 1,000 votes that could vote against them. But it all comes down to the share numbers and what the voting rights are. And so they've set those things up well enough to protect the ones that the VCs will come in under a Reg CF, or a 506C or any of those kind of things now.
Well, the Google Ventures example is a good one, so I'll have to go back and see what percentage of those you can buy into through one of those three. It is an interesting question, and certainly if you can do it for something that's truly attractive, then that would be interesting. I just wonder if you can make. I gave a presentation a couple weeks ago, but we're saying maybe 50 if you're doing the soup. Now, the other thing is these are more venture stage, because if you're an angel, most people are going to get some sort of decent sized check right at the very beginning, and then it'll be a little bit later, so it's probably not the, Facebook at a pre of 500K or whatever, but yeah, if you could get into Facebook at a pre of 10 or 20 million, then that would still be attractive for a lot of people if you could do it.
Yeah, and the company like that is either going to be a VC-backed company and not raising on one of these platforms, or they're going to be a non-tech company and they're raising money under Reg A+.
Which kind of company?
A company that's got a $20 million valuation.
Mm-hmm.
Okay? Because, they're not gonna raise, they might raise under 506C, but if they've got that kind of valuation and that kind of traction, they're gonna be talking to VCs or private equity funds. So, what we're dealing with are companies that are not yet there, okay? That we as individuals have the ability to participate in and share in their next growth phase.
So why does a company that could easily get angel or early venture capital investing do a crowdfunding versus the private route? Would there be any reason to do that?
Because the word you used, easy, it's not easy.
Well, that's what I'm saying, is if there's a selection bias where the higher quality companies are getting very, selective groups of investors, and then the lower quality ones are the ones that are gonna tend to migrate to crowdfunding, which has always been the reason that I haven't looked at it very much, but.
Well, that's the assumption a lot of the investors make, but you just look at it like in Atlanta. Look how many, there's 500 companies over at Tech Village. Is there enough capital in Atlanta to put money into 500 companies? No.
Some of them are doing ICOs. I don't know of any of them that are doing the other types of crowdfunding.
It's hard to raise capital. There's not enough of that, and it's a very narrow focus. So, if you're trying to raise money, the thing is that you can control your message. And a big thing, like when I ran my angel investor group, one of the things that companies liked about us, and when I did my big private equity conference, is that people had a story to tell. And and I saw all the time how companies that would come in and they might be, they might be a certain kind of a company, let's say it's a home health app, right? It's a bedside care home health app, right? And somebody's like, I only invest in fintech. But, you know, if I went and said, hey, there's a home health app, when you wanna go look at it, we're like, that's not my thing, I'm not in the medical space, this, you know, it's too much stuff, security, what Internet of Things, whatever, you know, I talk about. But if they were sitting in a room, because there was a fintech company that was presenting, and they sat there and they went, you know what? My mom has just gone through hospice back at home. And I saw the struggle that they had. If they had that app, it would revolutionize that industry. I'm gonna invest in that app. See, that's the thing, you don't understand, when you stand, angel investors have their box that they're gonna check, this is the kind of things that are invested, the ones that are traditional, that call themselves angel investors. But when you get into a room and somebody tells a story, you don't know how it's gonna relate to them, and something that they have a hobby in, that they didn't know that product could exist, they never thought of that product before, or they have some personal experience that happened with them. We had investors that a company almost got launched. It was a movie got launched. It was a vampire movie before vampires were hot. And the reason why this guy that was a wealth manager, conservative, and this guy that had invented satellite tech and made tons of money on the IPO, they invested in the vampire movie, was because that wealth manager had 2 teenage sons that knew about Saw and Cabin Fever before they ever came out, and that movie had a strategy to go to market that was going to be tapping into that same viral market of that stuff. And he was like, okay, they're going to be all in on this. They're doing Dragon Con, they're doing Comic Con. He says, give us a piece of the downside action on the merchandise, and we're in. Right? See, so you just don't know. I would never have taken that company to those guys as a movie. You're gonna like, excuse me, I've got this vampire movie I think, you know, you might be interested in. They would have just like, what? Carrie, are you smoking something? You know what I mean? But the thing about any kind of general solicitation, the company controls the message, and they get an opportunity to do that. And when people are out there searching for something that is something that they're interested in, they see whatever it is, and they Google it, or they've got a news feed going, and it hits their news feed, and they go, oh, I didn't know a company was around that could do that. Now they go to that page and they see an investor relations tab, or they see them on a Reg CF thing, or something like that. They invest out of emotion, and my goal is to get them to put the business, the objective side of that those traditional angels do, that they look at the metrics of what that company's gonna do, what the competition looks like, what the market space looks like, and then they make an investment, because it becomes a compassionate thing. It's something that it's not just about making the money, it's not buying and selling stock and buying and selling real estate, it's about helping an entrepreneur grow their business and create jobs, and helping to bring an innovation to the market that didn't exist before.
The other interesting question is, if you were a company and you had a choice between doing one of the U.S. crowdfunding options, and then doing an ICO where you could raise, you know, money from any international market, it would seem like the ICO as one of those options would have a lot of draw factors.
Everybody's leaving. Here's all my stuff. Grab a card on the table, or to reach me, get me on social media. Thank you for attending. And you had a question. I'm gonna come back to your question.
Angel.co, that's the website?
Yeah.
You have to be accredited though.
Okay, got it.
You have to be an accredited investor.
Oh, got you.
For Angel List, you can to invest through there. They actually now have all kinds of offerings that they're doing. They're listed under, if you Google crowdfunding sites, they're listed. Angel.co is listed on
We
this.
should bring it up.
Okay, good deal.
But yeah, so each deal is going to be different depending on how the offering structure is.
Sure, no, this is good stuff. I'm gonna get your book.
Okay, great. Thanks.
Have a good one. I'm glad I came back.
Yes, I am too. Thank you.
I downloaded the free sample on Kindle right now, so I'll check that out, and then maybe buy it if I like it.
What year did you graduate?
I graduated in.
Oh, okay. 2 years ago. What I really thought was interesting is I was thinking about it from a fundraising perspective. We just raised a seed round, evolving builder will raise a Series A in a year, but what if we don't get to the growth that we think? And I think this is interesting because it gives me another more thoughts
About different ways to do it.
different avenues to get that.
Yeah, and I've had some entrepreneurs buy it just because of that stuff.
So you're a private company looking for angel investors?
Yeah.
No, we raised, we had a really large.
I'm looking for companies to angel invest in.
Oh, there you go.
Yeah, so y'all should schedule lunch.
So,
Do you have are you at Being right over here?
yeah, I'm over there.
Do you have a card on you?
I don't have a card on me, but I'll take your card.
Yeah, so we founded Killian.
Oh,
It's an app for kids parties, kind of like a
Brand.
Okay.
kids
Okay, I'll check it out.
Yeah.
Yes,
that's
yes.
an idea with that. Michael.
Okay.
But,
Oh, yeah,
just
okay,
Rands, see Ron,
okay.
I put my.
Did you connect with me on Facebook?
Sweet, yeah.
So we have our
Okay.
150 companies on that, trying to using my name, GRs.
Okay.
Thanks, y'all.
But that information there, just trying to
Okay.
take care.
Off top.